Good morning, everyone. This is Dr. Vineet Chauhan, and we are discussing the topic of corporate finance, which is under the paper of BM 257 for MBA second semester. As per the subject's requirement, we will today first check it out about the basic terms of corporate finance. The course of finance is divided into various parts. As we can see, we will start with the aims and objectives of financial management, which also includes the risk and the risk premium, the meaning, the definition of the risk. So, in the first lecture, we will try to cover the aims and objectives of finance, corporate finance, and then thereafter we will check it out, the risk and return concept. As we start with the basic things of the financial management or the corporate finance, that is the meaning of finance. The financial management includes the optimum utilization of various economic resources, which is included also in the corporate finance. So, as a basic term, the definition of financial management was included by me here, which says that the financial management is the optimum utilization of the important economic source, that is capital fund. This definition was given by Isra Solomon. The another definition which I have added, that is given by Harvard and Upton, which says that implication of planning and control over the finance is called as financial management. With the definition, it is also clear that financial management includes the part of business management. It is to be done as a continuous administrative work or day-to-day activity of the business. It is scientific and analytical because various analytical methods, various scientific instruments are also being used to calculate and to identify the future requirement of the finance. It is centralized in the nature because the work of financial management is done by the finance controller or chief executive officer finance. Thus it is said to be highly centralized in the nature, and the financial decisions will also be taken by only one person. It is different from accounting, since the accounting is being done with the help of the past figures, while in the corporate finance we use the past figures, and with the help of the past figures we will take the directions and we will identify the measures which will be used in future. Since the financial management is related with the use of funds of the business, it is important for all the types of business, because each and every business want to know the cash requirement and their requirement of finance in advance. So this is the subject which will provide the easy access and the information regarding the finance of regarding the finance or the financial part of an organization. Now let us look ahead the objectives of the financial management. The objectives of the financial management is divided into two parts: basic objectives and other objectives. There are two basic objectives of the financial management. The first basic objective of financial management is the profit maximization, which means that the aim of the company or the company's finance is to increase the profit of the business. If we talk about the profit, certainly the profit is the most important motive behind each and every business and economical activity. Thus, the profit maximization looks to be a logical point that without the profit, no business activity will run. And it seems to be a logical, it will be the measure of economic efficiency that in case of more than one type of business, we want to identify that what will be the measure or how we compare the two businesses, that is with the help of their profit and their earning capability. The major source of motivation is also the profit in the business. Without profit we cannot or we cannot improve, we cannot ask our employees to work with us. So the major source of motivation behind each and every business is profit. If the profit will be increased, certainly the employees will believe that they will also get something more, and the other people will also believe that the business will goes on for a long time period. Thereafter, the maximum social benefit is also the another work, because today in the modern era each and every concern is looking at towards the social benefit, and corporate social responsibility has gained a momentum in the society. The social benefit is always subject to the profit. If the company will not be earning profit, then the company will not be providing the social benefit to the other people. So that is why the social benefit can also be provided in case the profit exists in the company. The profit is also based for the decision making in any of the concern. Decision making is always based upon the main point, which is that what is the ability of a company to earn or to gain the profit. If the company will gain the profit with the decision, certainly the decision will be taken. If there will be no profit, or if there will be no economic benefit of an activity, that activity will be eliminated, maybe this time or maybe next period. Applicability of in all the business or organization. Each and every business wish to increase the profit, wish to want the profit, and that is why the profit maximization is the objective which is behind each and every business house. But it is not the only objective, and there are some limitations of the profit maximization. It is said that profit maximization is vague or unclear. Since in a company there are various types of profits, like the company's balance sheet will provide several profits like profit before tax, profit after tax, profit before depreciation, profit after depreciation before tax, profit before extraordinary item, profit after extraordinary item, profit before explanatory item, and profit after the explanatory item. Profit of the last year, profit carried forward to the balance sheet. So there are n number of profit, and it is not clear that which profit is to be increased. So that is why there is a limitation of profit maximization which says that it is unclear that which type of profit is to be increased. Next, it ignores the time value of money. If the profit is the only motive, then when we compare the profit of two different periods of a certain company, we always ignore the time value of money. Profit, if it is increased from the previous year, we say it is good. But sometimes it happens that the profit has not been calculated on the basis of the time value of money concept, which says that the value of money will goes down after a certain time will be passed. So that is why the time value of money concept is important, and that should be considered. So in the profit maximization, it is not considered. The another major limitation is the quality aspect, which is ignored in the profit maximization. If the only aim of the business house is to increase the profit, certainly the profit will be increased by hook or by crook. I mean to say that profit will be increased by doing such activities which will not be in favor of the organization for the future period. Like the company will buy low quality or cheap raw material, so that the product quality of the company's final product will also be affected, and the consumer may not buy the cheap quality product in the future. So that is why the quality aspect will be ignored in case we use the profit maximization as a concept. And finally, it ignores the social responsibility, because if we have to increase the profit, certainly for increasing the profit should not be invested in the corporate social responsibility and other social benefits. So that is why the profit maximization objective will not be used in case the social responsibility is to be increased. So that is why the profit maximization objective is having various limitations, and as per the limitations, the another objective was developed, and that is called maximization of wealth. Wealth maximization is again a new concept which says that the company has to increase the wealth, or the management has to increase the wealth of the firm. The wealth means the present value of the firm, means the company's manager and managing directors have to do such a things by which the present value of the firm will increase. They have to take a decision by which the value of the firm will be increased. The net present value is also taken in terms of the present value minus initial capital. And the basic change where it is seen, that is that increase in the wealth means increase in the price of the shares. So company's share price will increase, that means the wealth is increased in a company. Now since we are taking the wealth maximization as a superiority over the other objective, that is profit maximization, so I have listed out some points which are stating that why it is superior than the other objective. Number one, it is clear, because in profit maximization we were not clear that which type of profit is to be increased, but here we are very clear that we or the management has to take the decisions by which the share price of company's share will increase. So the wealth maximization objective is more clear than the profit maximization. It will also consider the time value of money, as we are calculating the wealth maximization by assuming that the net present value of the firm is to be increased. So that is why the time value of money concept is also used in this objective, and thus this objective is superior. Next is that this concept watches the interest of all the section of the society. Certainly if the profit will be increased, then the profit will be increased by hook or by crook, while the wealth will be increased if there is a positive perception about the company to the common people, and the positive perception will come with the help of the company's efforts for increasing or in taking interest in all the section of the society. So societal benefit is also one of the major consideration which is of wealth maximization. It also directs for the clear dividend policy, means that the dividend policy should be like this. So with the help of that dividend policy, the value of company share must be increased, and it also takes the risk factor into consideration for investment decision, which means that before taking each and every decision, it is to be checked that whether the risk is more or less with the help of this. If the risk is more, then those decisions will be taken carefully so that the profit can be increased or decreased. So these are the two objectives, and the next part is that how we achieve the maximization of the wealth. So wealth maximization can be achieved by few points. Number one, to avoid the high level of risk. If the company will take the high level of risk, certainly due to taking the high level of risk, the business may suffer loss in the future, and the loss will reflect the negative profit in case of wealth maximization and decrease in the value of company share. So the risk is to be minimum for a company, and if the company will take the minimum risk or less risk, certainly the profit will be more. Company has to work for reduction in the cost. So if the cost will be reduced, by such a way that the company's benefit will be more and the company will not lose its public image, then it will be looks as a good or maximized approach for the company. Pay dividend is also another point, that if when the company pays the dividend, due to payment of the dividend, the company's share price will be more, the people will believe or the investor will believe that company's profit will be more, and that is why the company's wealth will be increased. The next point is seeking growth. If a company will seek the growth, if the company will not invest all the profit which they have earned into the dividend, certainly there will be a growth. The growth which is due to the efforts of the company's managing directors, as well as which is due to additional investment in the form of the reserve and surplus to the business. So the growth seeking is also another objective or another point by which the company's wealth can be increased. Next is to maintain the share price or to maintain the market price of the shares. If company is to maintain the market price of the share, certainly that is the previous point, which is payment of dividend, seeking the growth, will be helpful for the company. So by doing this, the company will be able to provide more and the company's wealth will be more. So these are the two major objectives of the corporate finance or financial management. The other objective also includes like planning of fund, which is the traditional approach in which the company has to see or the finance manager has to do the work by which they can generate the finance. So planning for funds is important. Then raising of funds means the funds are raised from the sources, various sources. So from which source the funds can be raised, it is also important, and it is the decision which is also taken with the help of the financial management. Next is allocation of fund. Once the funds are received, how the funds will be allocated, so that the funds will be given in different department as per the requirement, and due to allocation of fund, the company's profit will be more, and that is also included in the next point, allocation of income. Allocation of income means that how the company will generate the profit, and if the profit is generated, where it should be invested. Monitoring of use of fund. The funds which company has generated, it is important to check out or to monitor that where those funds are invested. Those funds must be invested in appropriate manner into the place or into the point where the company has planned. So monitoring is also an important point. And then finally, the liquid position management. Liquid position management means position which is in which the company is having at the purpose of or for the purpose of its current day-to-day requirement or working capital finance. So the working capital finance is another point which is to be taken care with the help of the corporate finance. Now we will go ahead and check it out that how the market capitalization or how the wealth maximization is being calculated. The wealth maximization is the function of net present value and the net present value or the absolute measure of economic value added. But before we go there, we will have to take it out the two terminologies which are used. First is market capitalization. The total market value of company's equity equal to share price, and it is divided by it is equal to the share price times number of shares outstanding, means the number of shares into the price per share, that will be the market capitalization. Market value added is another terminology which is used, and it is calculated by reducing the book value of equity from the market capitalization. So these two terminologies are also used. The next terminology which we will check it out, that is economic value added. Economic value added is treated to be or is assumed to be the best measure of calculating the firm's wealth maximization. It is the measure by which the company shareholders will be able to know that company has increased the wealth of the shareholders or it has reduced the wealth of the shareholders. EVA is the absolute value which is calculated for a firm when the firm's capital is to be changed or it is stable. It is used in terms of the forecast for EVA, and discounted EVA is also being calculated for the purpose of the wealth maximization calculation. The better format of calculating EVA is also included here, which says that return on investment we have to calculate, weighted average cost of capital is reduced from which, and the remaining is called spread. That spread is multiplied with the operating profit, so by which we can calculate economic value added. But the corporates are calculating economic value added with the help of the next formula, which is using the net operating profit after tax. So the formula is net operating profit after tax minus capital charge. The capital charge is calculated by multiplying weighted average cost of capital into the capital of the company, means the total amount which is paid by the company as a cost of capital. So if the company is earning more than its cost of capital, then the wealth will be maximized. The answer of this formula will be positive, and if the answer is positive, certainly the result is positive EVA, and positive EVA means increase in the wealth of the shareholders. The another format which is used for calculating EVA, which is the formula base, and in this part we are showing the four different parts, that is operations or operate, decrease means by the cost, build the economic value added, and finally the redeployment of the capital so that the company's wealth in the future will be increased. So these are the 4 points which is fundamental strategy for increasing the EVA. Now the next part is the organizational structure. The company's organizational structure has the different persons which are at different level. So I have made an organizational structure which is having board of directors and managing directors at the top. After that there are various areas in which there are various managers like production manager, personnel manager, finance manager and marketing manager. The finance manager is posted at the third level, where the board of director and managing directors are their bosses. So since I told that it is highly centralized, so the finance function is centralized here. In the work of finance manager is divided into two parts: work as a treasurer and work as a finance controller. Work as a treasurer includes the two types of transaction, which includes the cash transactions in the form of banking transactions and cash management, which is managing the cash inflow and outflow. The finance controller part of the finance manager includes various functions like general accounts, salary administration, financial statements, preparation of budget, making the internal audit, tax administration, and is also responsible for the safety of the records. Role of finance manager is another important part, which is in the form of various four functions like raising of fund. He will decide that from where the company will raise the fund. The allocation of fund, he will also identify that from where the fund is being allocated. Planning for the future profit, that this will be the plan, and understanding the capital market by which they will go into the capital market, and the finance manager will provide help to the company for the purpose of providing the finance. The another concept which is to be seen as a basic of the corporate finance is the time value of money. Before we enter into the time value of money, we will check out what is the basic objective of the financial management. The basic objective of financial management is the wealth maximization, which is possible only with the required rate of return. Means, what is the rate by which the company wishes to earn? So, if the cost of capital, suppose it is 12%, certainly the company wishes to earn more than 12%, so that all the funds providers are being paid in full, and there may be certain part of the profit which will remain in the company for the future growth of the company. Thus, the required rate of return includes the two parts. Number one is risk-free rate, means the rate which is free from risk, the rate at which a company will earn or a person will earn without taking a risk. So, zero risk rate of earning is called risk-free rate. Risk premium means by taking the risk of losing the funds, the company can earn some more profit. So risk premium is the part which company will earn due to taking the risk. So risk-free rate is always subject to the time factor, that at what time it is invested, when it is invested, and what will be the risk-free rate of the time. And risk premium is related with the risk. So the time value of money is the concept which includes or which says that the value of money after passes of a particular time, or after the passes of the particular time, what will be the value of money, that will be included in this concept. This concept says there are two types of values: future value and the present value. Future value means the value of future. That means the amount which is received, if it is deposited today, what will be the value of that amount in the future? That will be called as the future value. While the present value is reverse or opposite of the future value, which states that what will be the value of the company's profit or the company's financial requirement in the future. So what we have to invest today, which means that for an individual, the amount which will be received in the future, the value which is to be invested today is the present value. For the purpose of calculating these two values, there are 3 or 4 different calculations. The simple interest and compound interest is calculated. Normally, in the business where yearly returns are being compiled, the compound interest is being used, and that is why the future value technique includes annual compounding, where annually it is to be discounted and to be calculated. Biannual, where 2 times it is being calculated. Quarterly means in a quarter. For calculating the future value, we will use the formula A is equal to P within bracket 1 plus I is power n. A is the amount which is received at the end of the period, P is the principal amount, 1 is constant, and I is the interest rate, n is number of years. The present value is calculated with these three types. It is calculated with the formula P is equal to A upon 1 plus i's power n, or with the help of calculator by using 1 upon 1 plus rates power n, and again it is divided by 1 upon 1 plus rate. Whatever is the answer will be divided by again 1 plus r, so that next year's value will be calculated. And the third and foremost use of the table point, with the help of the various present value tables, we calculate the present value, and the present value is calculated for future cash inflow with the present value table, and whatever is the inflow is multiplied with the table value, and the answer is the present value of the question. The next topic which we see, that is the risk and return. Risk and return is a concept which is always be point of greater importance in the finance. Return means the yearly receipt which is result of an investment proposal or an investment for or in a particular security. If a person will invest, or if a company will invest in a project, then whatever is being earned as a profit or as an interest is called return. While the risk means the uncertainty of the return. So uncertainty of return is the risk, means variation in the return, whether the return will be more or less, that is the risk. To reduce the risk, a company or person will always use the portfolio, which is combination of more than one type of security with a different cash inflows. So if different cash inflows and different type of security is available, with the help of a simple part, by multiplying the return into their probability, we calculate return of one security. Similarly, by calculating the same for another security, we calculate the return of another security. And if we have been given the percentage of their weight of those two security, we multiply those total with the help of the equal percentage, and we will get the return of the portfolio. So portfolio return is the function ERX, which means that return of the joint or combined return of the security. The another point which is considered here is the variance and standard deviation. Variance is the square of the standard deviation. So the standard deviation is calculated in two different securities with the help of their return probability, return minus their average return square, plus P, return in second security, minus the average return of the second securities square. So with the help of this formula, we calculate the variance and standard deviation. The standard deviation is treated to be the risk of the company's security. So that's it in the introductory session of the corporate finance. Thank you.